Thank you to the few of you who just joined. I'm going to give it another couple of minutes. So if you just hang tight, we should be off to the session in a moment. But thank you again for joining. Thank you to all who just joined. On a technical note, the person who was supposed to support this is not able to join. So I'm trying to see if I can disable the waiting room so I don't have to keep toggling. So just give me a moment and we'll get into the session in a moment. All right. Well, thank you again to those of you who have joined. My name is David Jaber. In addition to serving as the founder of Climate Positive Consulting, where we work with companies to measure their carbon footprint, craft climate strategy, and drive greenhouse gas reduction, I'm also a Terra.do instructor. And we have a on-demand class that goes into depth into some of the material that we'll kind of talk about today. So I've been managing Climate Positive and its predecessor company for about the last 15 years. And in terms of location and bioregion, I'm in the eastern part of the San Francisco Bay Area. Part of the reason we're here and part of the reason Terra.do's had me do this is this focus on corporate climate strategy has dramatically escalated in the past 7 years. You can actually think of business strategy as a climate solution in a way. And the core of it is carbon accounting. And so we're here today with the intention to shed some insight on how it works. There's only so far we're going to be able to get into an hour, but let's do what we can. Some of you may be quite familiar with accounting and how it works. And for others of you here, I imagine it might be completely new. That diversity in this group is completely okay. You know, you come to this meeting with kind of the details and the information that you have. And so with that, how I want to start this is actually to give you some time to either brainstorm or just surface some of the questions that you have relating to carbon accounting. Give me 1 second to check the waiting room. Okay. And yeah, as I was saying, I think you should all put you into breakouts to give you some time to at least introduce yourself to some of the others gathered here. Most important is to brainstorm the questions you have on accounting. So you'll have a few minutes to discuss that with others. I would ask at least someone in the breakout room to record a couple of key questions, as when we come back to the main space, I'll ask you to articulate those, whether you can come off mic or even sort of drop it in the chat when we're back. And then depending on the questions that come up, I will either answer it in the flow of some of the prepared slides I have. I might handle it in the QA at the end. And depending on the question, maybe even it might make sense to handle it up front. I don't know yet. And for those of you who haven't come here with questions in advance, if if that's completely fine. If questions come up in the course of us walking through this content, you'll have an opportunity to bring up those questions at the end. So the bar on deliverables here is pretty low. It's just really just an opportunity to ensure your questions are addressed rather than me just spew out a couple dozen slides at you that might not be informed by kind of what the information that you really need. Is everyone ready? Okay, great. So give me a moment. Looks like we have, let's see, 22. Okay. Breakout rooms are now open. And so I'll give you maybe 5 minutes to sort of brainstorm, and then we'll come back to the session. You can tell me what you came up with. I'll see you soon. So now what I'd like to do for those of you that were able to participate, for those of you that are willing to come off of a microphone and just articulate some of the questions, I will kind of take those down initially and then kind of sort out maybe when to address them. If you'd rather put them in chat, that's fine. We'll try to pick those up as we get into sort of the Q&A. But anyone feeling inspired to offer some questions?
Hi, David. I'll speak for our group. So I had taken the course a couple of years ago, and so really joining today, I was trying to understand if there's, significant changes over the last couple of years that you might in the program and just like in the tools and the accessibility to um, energy data. Remember, we went through, the list of tools that were available to find out what your cost of energy was in a particular region. So just any updates that you've had over the last couple of years. And then Tarun was mentioning that he'd be interested in knowing about, the best calculators being deployed today, those kinds of things. So
Got it. Thank you. And your name did look familiar. Welcome back.
thanks.
Anyone else?
Sure.
Please go ahead.
Yeah, so I was discussing with Claire and Poonam, and we were wondering what the main reason apparently for us was to know more about the impact on the ESG reporting and where to find data and everything that needs to be put on reporting for carbon reports into ESG, generally speaking.
Okay. Were there any specific ESG reporting? There could be like different frameworks you require.
Well, in my case, I'm more on the current reporting standards in Hong Kong, so that would be following mostly the TCFD. But
okay. We won't be talking about reporting a lot today, but I think there's standards around carbon accounting that would feed into ESG reporting. So I'll try to get into it that way. Thank you.
great, thanks.
We'll take a few more.
I think just as someone who hasn't been through the cohort yet, hearing kind of your layman's explanation of what carbon accounting looks like today and maybe what kind of experience you would need to break into a role that concerns carbon accounting.
Okay, thank you.
I have one more question, David. With AI becoming so popular, how is that changing the way we do emissions accounting and projections? If you could touch upon that as well.
Okay, sort of related to the calculators question and a few other things. Okay.
Kind of, to make it easier.
I was also curious about if for projects that are sort of orienting from agricultural grassroots projects and trying to get those carbon credits to people who are creating agricultural carbon capture, what that actually looks like and kind of just how is that built actually. Thank you.
Sure. One thing I should probably flag, I think you're raising a good point. So this is generally going to be focused on organizational accounting and how an organization looks at their carbon footprint. That's a slightly different world than getting carbon credits from specific projects. We're probably not going to get too far into sort of the details of that. In the folder class, we have a sort of a conversation about offsets kind of after accounting, but let me think about that more as we kind of work through this hour. Okay, great. So thank you for those who articulated questions. Please use the chat to add other ones, and I'll do my best when we get to the Q&A to kind of get into that. Maybe just to address sort of a couple of the higher level questions. Mary asked about significant changes in program. So the greenhouse gas protocol itself has not really changed fundamentally in terms of like scope 1, scope 2, scope 3 since the original scope 3 standard came up in 2013. They're now in a process to actually update that, so there could be some changes. But in terms of the accounting rule set, that's largely the same. When we look at things like after you've done the accounting and you want to set reduction targets, one of the key framework for that is science-based targets, and that has been evolving pretty quickly. It's much newer, and probably every year or even every several months, there's some nuance that they change. So that's a pretty dynamic space. I think the other questions, I think we'll get into like what accounting looks like. Certainly, that's sort of the core of it. So I've noted those questions, and we'll come back to them to the extent I can in our time together. So when you're looking at greenhouse gas accounting, there are terms that invariably come up which may or may not be clear. So when I want to first start to define those, for those of you that are well familiar with greenhouse gas accounting, particularly if you've already taken this course, as Mary was saying, just bear with me for a few slides. And hopefully we'll get to some more interesting content for you. So greenhouse gases are what we are attempting to account for in carbon accounting, which is more properly known as greenhouse gas accounting. There are 7 different types of greenhouse gases you're required to track by the international standard that governs emissions accounting, the Greenhouse Gas Protocol. But so carbon footprinting, carbon accounting, greenhouse gas inventory, all of those terms are often used interchangeably. I will use them interchangeably. But we're really making this attempt to measure the greenhouse gases that are generated out of your operations. And I'll say that this accounting is also mostly built for businesses. It's called organizational accounting, but it's usually thinking about sort of a value chain where you're taking in supplies, and if you're a manufacturer, those would be like raw materials or ingredients. Those are being processed, sent to your facilities, and then you're shipping them to the customer. So it's really with sort of that view in mind. And so the greenhouse gas protocol was developed to help account for along this value chain. Greenhouse gas protocol says there's 7 greenhouse gases, and in some cases, classes of greenhouse gases that you're required to track. Most businesses are dealing with 4 of those, but maybe just step back to even a higher level first. So the first step in greenhouse gas accounting is to determine those organizational boundaries. Once those boundaries are set, the emissions that occur from directly within those boundaries are scope 1. So those are typically coming from facilities and from fleets of vehicles as the main assets you have as a business that generate greenhouse gases. So literally from smokestacks and tailpipes, along with some escaped, what we call fugitive emissions, things that escape from your operations. Those are all scope 1. Scope 2 is a type of indirect, and for most companies, their only scope 2 is electricity. The idea there is that you make decisions from within your boundaries that affects the utilities that are wired into them, but the emissions actually happen at the other end of the wires or the other end of the pipes at the power plant or place of generation. And so scope 1 and scope 2 are really sort of what define your facilities, and the vehicles you own really define scope 1 and scope 2. And then scope 3 are all the emissions outside of those boundaries, but are within what's called your value chain. So again, if you make a product or a service, there's this chain of raw material extraction and processing and packaging and transport that's needed, as well as your own packaging and product or service delivery. And you can even look at things like your customers' use of the product. How are your design decisions and what is in your product kind of affecting their greenhouse gas emissions at their site? And so all the greenhouse gas emissions associated with that effort outside of your boundaries are called scope 3. You could technically also think of all emissions as the scope 1 emissions of some entity. So technically your scope 2 emissions are the scope 1 emissions of your electric utility. And the scope 3 emissions of your upstream supply chain tend to be scope 1 and scope 2 emissions for your suppliers. So whether any specific release of greenhouse gases falls within one scope or the other actually depends on your frame of reference. And if this happens to mean sometimes there's double counting between different entities because your supplier is saying it's scope 1 and scope 2 and you're saying it's scope 3, that's actually completely okay to have that type of double counting. It's inherent in this framework. And then just to get into a few other terms that will frequently come up in this. If you see EF, that's referring to emission factors. Emission factors reflect the fact that the data we have for greenhouse gas accounting is not generally greenhouse gases themselves, because we don't have direct monitors that are showing how much carbon dioxide and how much methane and how much nitrous oxide are escaping at all the billion of point source combustion, fossil fuel combustion kind of around the planet. So emission factors take the data that we have, that might be like gallons of gasoline, and convert that into greenhouse gases. Global warming potential is the climate impact of a gas relative to carbon dioxide. So where emission factors are telling you how much of the gas is generated, global warming potential is telling you what is the impact of that gas compared with CO2. Because carbon dioxide is so prominent, it's the standard by which other gases are judged. And then MTCO2e is metric tons of carbon dioxide equivalent. Those of you overseas, because you're not still on the English system, you're already on a metric system, that you might see just TCO2e because tons inherently means metric tons. In the US, you'll see MTCO2e to call out metric tons. And this is the currency in which carbon footprint is measured internationally. And then I've already talked about sort of the interchangeable terms, but footprint, accounting, inventory, all those terms just mean sort of the total emissions. And so this diagram illustrates the 3 scopes. And you'll see this all over discussions. This also comes from the greenhouse gas protocol. So I mentioned the 7 gases. So here we have carbon dioxide, methane, and nitrous oxide. These 2 in the middle are classes of gases, actually, hydrofluorocarbons and perfluorocarbons. Hydrofluorocarbons are the gases in refrigerators and HVAC systems that give them their cooling ability. These last three tend to be specialty industrial chemicals. So I already talked about perfluorocarbons. Sulfur hexafluoride and nitrogen trifluoride are sort of the last three. Most companies, most organizations only have to deal with sort of these first four. And so you see scope one is in this center arrow with the facilities and fleets, scope two, indirect. And then we have 15 different categories of scope three. I will touch on a few prominent scopes or categories of scope three, but not get into all of them today. But here we have purchase goods and services, capital goods, fuel and energy related. There's transportation and distribution. And the reason there's two arrows is that this is depicting upstream, and this is depicting downstream from your operations. So all the things that go into making product, if you're a manufacturer, and then all the things that it takes to sort of move that product and use that product. This same structure applies for service companies, but service companies have it easier in a sense because they're not moving physical products. So there's a few aspects of this, like transportation and distribution, don't really apply. And other things like processing and use of sold products might not apply either. So just to step back and call the question, why do accounting at all? Why do we need to go through this process? The goal of accounting is to come up with a measured amount of your organization's contribution to climate change, with the idea that you then pinpoint major contributions and work to reduce them. However, if we know fossil fuels are those major contributors, you could ask, well, why not just phase them out? Why go through all the trouble to tally the amounts of each greenhouse gas source used, apply these emission factors, and quantify footprint? When you could instead just look wherever you're using fossil fuels and just try to get rid of that. My answer to that is significance. Accounting tells you what's significant. And as it says here, facilities are very visible, but if you go through this process and find that it's only 5% of your footprint, it probably wouldn't make sense to invest 50% of your total effort and budget there. What accounting is enabling is us to strategically approach greenhouse gas reduction and focus on hotspots and things that are significant in a way that simply diving into your nearest climate solution doesn't. And so I mentioned this first step in the accounting process is to define your boundaries so you know what falls within scope one and scope two. We have three options to define those boundaries. And in the interest of time, I'll probably just first call out. So operational control is the one that I find most commonly used in my work. And so if you're in the business of manufacturing a product or providing a service, you are operating facilities and fleets, whether you own them or you lease them. And these are the assets over which you have operational control and which you'd include in here. Financial control is different and could be appropriate for, say, a holding company where they account for emissions of organizations where they have effective financial control. And so in a lot of cases, that means 51% ownership. So in this case, if you were using financial control wherever you had 51% ownership, you'd account for all those emissions. If you had partial ownership, but less than 50% in other places, they would not fall into your accounting. And then equity share is an attempt to get those lower portions of ownership into control. With equity share, you take a proportional control, whether you have 10% ownership or 100% ownership. And so when you apply these tests, you would identify assets that generate greenhouse gases. I've mentioned buildings and vehicles. Technically, there could be equipment or even land. If you're a holding company that has like ownership stakes in like multiple companies, you would come up with sort of companies that would sort of fall within your kind of scope one and scope two emissions. So that's it in a nutshell. You could get into some depth here, especially if you're looking at specific instances that have complex ownership. For a lot of organizations, their operational control is exactly the same as their financial control because the only things they own are sort of the assets that they're operating. So moving on to the next step, now that we've determined what our boundaries are. This treatment might help make it a little clearer. This is just sort of a fictional company where it's saying scope 1 and scope 2 is these operated facilities. So in this case, it's saying they own a corporate headquarters, they're leasing a sales office, they have a manufacturing facility and vehicle fleet. And then what comprises their scope 3 are the things captured in their value chain. So it's the raw materials and supplies they're buying, it's the processing and transport of those. And then on the other side, they have to move product to customers through third-party warehouses, and you'd have customer use and possibly even sort of retail sites depending on what you're selling. So this is going to look different for different organizations. So everything outside of this, things that do not touch your value chain that other companies are involved with, you don't have to take responsibility for it. It's sometimes people think scope 3 feels like it's everything, but it's not really. It's the things that are directly in your value chain. Okay. So measurement basics, and this will hopefully help address some of the questions of like what carbon accounting looks like. So just to simply summarize the mathematics, and this is going to tap back into the emission factors I was talking about earlier. You want to know the amount of each greenhouse gas source. You want to know the emission factors that relates to that source. And then you want to know the global warming potential for each gas. So the example of like sort of a greenhouse gas source, I mentioned earlier, we're working with proxy data. So that could be gallons of gasoline. That can be kilowatt hours of electricity. It could be miles of distribution through trucks. There's all these different proxy sources we're gathering as part of this process to come up to understand all the different inputs. If you are doing this for your organization or your organization's working with a consultant to do this, most of your effort's going to be in this data gathering to gather all the data on the different greenhouse gas sources. So once you do that, I mentioned these emission factors. So for example, so for combustion, that generally, if you're combusting a fossil fuel like diesel, natural gas, fuel oil, whatever it is, there's 3 greenhouse gases that generates, and it's the first 3 that were on the diagram: carbon dioxide, methane, and nitrous oxide. And then what global warming potential does is say, okay, the emission factors just told me I'm generating, when I burn a gallon of diesel, I'm generating this much carbon dioxide, this much methane, and this much nitrous oxide. What GWP looks at is the global warming potential for methane, as an example, is 30. So I need to multiply the amount of methane that I have by 30 to get that in terms of carbon dioxide equivalent. And what that 30 represents is methane, based on our best understanding of the science, over a given time frame, has 30 times the greenhouse gas, the global warming impact of carbon dioxide. That's also part of the reason why even though methane's emitted in lower amounts, it's a bigger concern because it does have a higher global warming potential. And then the basic mathematics here is, you took your greenhouse gas source, you found out what kilograms of greenhouse gases are generated, you took the kilograms of greenhouse gas and put that to carbon dioxide equivalent, so then you can add everything together in terms of, this says kilograms of CO2 equivalent. We're generally converting that into the currency I mentioned earlier, metric tons of carbon dioxide equivalent. And so this is the core of the accounting process. It still strikes me as rather simple, given how much you hear about carbon footprints and companies laboring to produce a footprint. But this equation is really where the magic happens. And I already started to get into this, but just in terms of the differences between emission factors and global warming potential, because I know that gets confusing. If you're burning a gallon of gasoline on an on-site piece of equipment, and apologies to those of you overseas that were using non-metric, unlike most of the rest of the world, but this has been sort of a US-based course thus far. A gallon of gasoline or a liter of gasoline, it's saying you generate this much with a gallon, 8.78 kilograms of CO2, 3.8 times 10 to the -4 carbon or methane, 8.0 times 10 to the negative fifth nitrous oxide. And then here's the global warming potentials. And so how you do this, for those of you that are familiar with Excel and sum product functions, is basically just be a sum product function where you're multiplying down. So 8.78 times the global warming potential of carbon dioxide, 3.8 times this, 8.0 times this, and then you're able to add them up to get sort of the total carbon dioxide equivalent footprint for that amount of gasoline. And so I realize there still may be sort of questions, but this will hopefully kind of help you start to think about, how this process works. So we had some opening questions relating to data sources and tools. So what I would say is I think the real trick and the real key to accounting work is getting emission factors. So you can go through the process and gather the amounts you have on each, the amounts of diesel, the amounts of electricity, and the other sources of greenhouse gases. The global warming potentials are relatively fixed. The Intergovernmental Panel on Climate Change is kind of the international scientific body that is sort of owns essentially sort of the climate sciences, is kind of like the source of authority. They come up with the global warming potentials and update those maybe every 6 years, but those are pretty fixed, like once they're published. It's coming up with the emission factors with the hundreds and thousands of potential sources that you have that are sort of the real trick. The Greenhouse Gas Protocol offers the best sources are US EPA has a fairly comprehensive list of emission factors for greenhouse gas accounting. I would say even a better source, and one that we're sort of shifting over to more because there's some places where it fills some gaps that are needed for certain types of reporting, is it used to be called DEFRA in the United Kingdom. Now I think it's just the government of United Kingdom publishes annually a set of emission factors that you can find on their website. It's extremely helpful to being able to do this work and sort of convert greenhouse gas source data into footprint data. And then I think there's a few other sources I could, but in the interest of time, I think I'll push on because I do want to keep some time for Q&A. So I'll get into some scope 1 and 2 details just to help flesh that out, and probably stop for a Q&A at that point. So I talked about scope 1 as sort of these direct emissions, primarily combustion of fuels on site in facilities or in your cars and delivery trucks. And that's whether that's diesel, gasoline, fuel oil, natural gas, propane, or other, it generates those three key greenhouse gases that I just mentioned. There's also leakage of gases that are themselves greenhouse gases. So the difference here is with fuel combustion, you're taking something that's generally not even a gas, it's going to be liquid or solid, you're combusting it and generating greenhouse gases. Leakage has to do with the fact that you have greenhouse gases in your operations, but they're escaping. So one good example of that is methane, because natural gas is mostly methane. So if you have a natural gas leak on site, you'd be losing methane, and that would be a direct emission. The most common place this comes up would be with air conditioning and refrigeration systems, because those refrigerants are those HFCs that we just saw in the greenhouse gas protocol diagram. So that's primarily sort of scope 1. And then scope 2 indirects. With scope 2, you're connected to some system or some utility that's generating greenhouse gas emissions on your behalf. So you're making decisions on site to use that utility, but the emissions happen elsewhere. So they're referred to as indirect. I mentioned electricity. Notice also that heating and cooling is called out. There are cases where you could have steam or hot water or even chilled water prepared or created offsite that comes to your but that comes into your building. So it's offsite or it's outside of your boundaries, but you're getting heating and cooling from those other sources. One thing that injects a little confusion into scope 2, unlike scope 1, there are location-based emissions and there's market-based emissions. And you might commonly kind of see this as a sort of a reference. So I think it's important to get into it. So what location-based is talking about in the context of electricity is looking at your specific geography and location and kind of taking into account the various fuels that are feeding into the electric grid. So there's a lot of different things we could use to generate electricity, everything from coal to hydropower, and those have different greenhouse gas implications. And so what this map is showing you is in a relatively recent year, a map of the US that has been broken out into different regions by the US EPA, where the idea is that for each of these regions, they're sort of a function of how the electric grid is managed. And so within these regions, there's different carbon intensity where they've looked at, okay, so what are the different sources generating electricity? How much electricity are we getting, and how intense is sort of how much greenhouse gas intensive are those different grids? And so you can see this is reporting pounds of carbon dioxide per megawatt hour. Overseas, you might see kilograms of CO2 equivalent per kilowatt hour, but similar concepts. One thing you notice is there's some variation. So the West Coast and East Coast are relatively clean, like 500 and 600 are sort of the numbers, where in the Midwest and the Rocky Mountain areas, you have some hotspots. And meaning that they're just more carbon intensive because largely a function of kind of the extent to which they use coal. And so location-based measurement is simple. Whatever geography you're in, for every megawatt hour of electricity you use, that's how many pounds of carbon dioxide you're using. So you just sort of multiply your megawatt hours by this factor. So for those of you who may be in Canada, these emission factors are reported on a provincial boundary. So the province's political boundary is exactly sort of the same, which makes it simpler. And for many countries, particularly smaller companies, the geographic boundaries of the country are used for the grid. So that also makes it relatively simple. The US is just a little complex in the way that it's articulated. And so then there's market-based. Market-based allows you more accounting flexibility, primarily depending on the actions you take to procure clean energy. And so the Greenhouse Gas Protocol defined a hierarchy of market-based emissions accounting approaches. The higher you are on this column, the more credible that approach is considered for market-based reporting. So at the top, we have what are called energy attribute certificates. These are called RECs in the US. In the EU, they're called guarantees of origin or GOES. And the way to maybe think about this is every kilowatt hour of electricity that's generated from a renewable source generates two valuable things with the creation of a credits market. There's the kilowatt hour of electricity itself that goes into the grid and does all the things that we like electricity to do in terms of powering equipment. And then there's the renewable energy credit for a kilowatt hour. And so with the creation of a market, these two things have been decoupled, where if you say you own a wind turbine or large solar farm and you don't need to claim renewable energy from that, you can allow others to buy that credit from you so they can claim a renewable energy. And so the idea behind this is it creates an incentive for renewable project developers because you can find buyers for renewable energy credits. It could be those buyers would like to develop solar on their own sites, but they can't. But they do want to take credit for renewable energy. So under the market-based approach, you can take credit for those renewable energy credits. Under location-based, you can't. You're just sort of locked into your area or geographic area. And then PPAs, that's sort of a contract mechanism where you agree with a developer to purchase renewable electricity, generally renewable electricity for a certain price. It's sort of similar. Below that, you can have utility-specific factors where rather than look at those larger grids, which in the US were like a couple different, generally like 2 or 3 states, you could look at your specific utility and see what they report. This is where you can also look at utility green energy programs and take credit for purchasing clean energy through the utility. And then below that, we have some other factors that I don't think I have time to get into, but hopefully that at least gives you a flavor of how location-based and market-based works with electricity specifically. With that, I think I want to stop. So I will go back to the questions that were articulated. I also see some questions or I see some activity in the chat. So Angela, I might ask you to maybe sort of filter through that to see and maybe draw questions. But let me go back to some of the 6 or so questions that I took down earlier. Okay. So we had that initial question about significant changes in programs and tools. So programs, I think, have largely not changed. I had mentioned this is beyond accounting, but with science-based targets, they change pretty frequently. Tools, I mean, there's new tools like every month in terms of like online platforms, but they're all pretty functionally similar. I would say I have seen some more lower cost tools now come into the marketplace where 5 years ago, a lot of them were priced for sort of larger companies. And just to get into, and so I think that feeds into the question about sort of like best calculators. I guess the way I would say that is for organizations that are starting, we usually recommend, and we start ourselves and using our own process spreadsheets. We're using shared Google Sheets, so at least there's sort of shared access. But that's how we're approaching it versus going right into a software platform. Reasons for that include the transparency and comfort level people have with spreadsheets, the fact that a lot of companies, when they're starting, aren't necessarily committed to the process. And so if some of those tools are going to cost thousands of dollars to pay for, you want to be vested in it generally, especially for a smaller company, but then also make sure you have staff available to use it, because if you don't have staff bandwidth to sort of use the tool, it doesn't necessarily make a lot of sense to do the purchase. But there are calculators, lower cost calculators for businesses that want them. And then at a higher level, you can get access to some free tools that help you sort of get the process, but they don't necessarily have the granularity to make sort of like there's some pretty broad assumptions that are in some of them. But one source of those tools is SME Climate Hub. And then Change Climate, which has the climate label program, formerly Climate Neutral. They also have a free calculator where you can get sort of rough starting estimate of your footprint. But that's also a case where I think if you pay them for the tool, you can get better granularity. And then a increasingly popular question now maybe about AI. So I think AI has applications in the way it has a lot of applications where it can be helpful to get sort of maybe a first start. Because of accuracy concerns, I can't say that we incorporate AI that much into our practices. I expect with some of the online software platforms, they will start to integrate it. And so, for example, if there's a category of scope 3 that you don't necessarily have data for, AI could look at some industry benchmarks and come up with some estimates of like what the footprint would be for your footprint. I don't know the extent to which that's used. There's also some, I think, professional standards around that might need to shift. If you want your emissions to be verified, sometimes that means the verifier wants to track back to like specific sources. And if it's going to an AI source that just sort of basically kind of made something up, whether that would pass verification would be a question for me. But again, that might be something where now it wouldn't pass, but in 3 or 5 years, the standards on that might change, or people's comfort level on AI type of estimates might be more comfortable, because there's certainly places even without AI that we're making assumptions. And I will give you a few minutes, Angela, to bring up some of the questions, but let me just check some of the other ones.
Yeah, there are two questions in a chat. The first one from Mary: have you seen companies relocate to a lower emissions region?
Not generally. If they've been relocating, generally they're moving overseas for cheaper labor. I do know one company, example, manufacturing. They were manufacturing here, which would have been better if their footprint. For cost reasons, they started to move to China, which looked good until probably tariffs started flying around. So I don't know what they're thinking now, but it's I think there's usually other factors that do that. Although I have had companies that I've worked with for a few years and sort of flagged, hey, this is an issue and you need to invest in this overseas factory, where they said, well, we're looking at least onshoring, or at least coming closer, where it was Mexico versus Asia. But I think there were sort of other factors in that, probably just not necessarily greenhouse gases, but similar concerns about, trying to create jobs closer to home.
Amazing. And Hadar has a question on any idea about efforts to enforce carbon accounting and transparency from a policy standpoint, at least on local levels.
I mean, not on local levels. Well, I guess if you consider California local, like the state of California now has disclosure requirements. The EU has disclosure requirements kind of broadly on sustainability that were watered down this year, but I think those will still be underway. And usually the way I've seen those play out is usually they'll reference, like, you have to use the greenhouse gas protocol to come up with your numbers. They might require that you have to have it verified, so a third party is looking at them, which I wouldn't necessarily say is the same as transparency, but it's sort of saying, like, this organization that's considered expert looked at it and they said it was acceptable. Other than that, I think there's sort of these disclosure requirements that are part of transparency, although not quite the same as being able to see, like, how someone actually did the calculations in the way you can, if you're kind of working directly with them.
Thank you. I'm going to jump to Raharshi's question first, and then coming back to Bo, which is more carbon accounting certificate related. So for Raharshi has a question on, is carbon accounting best done as ex ante or ex post, or both?
I'm not sure I followed that. Let me look at the question.
Or Raharshi, do you want to come on stage and ask your question?
Yeah, sure. So my question was, is it done in the beginning when you're planning, or is it done after, basically?
Yeah. Carbon accounting is generally going to be a backward-looking exercise, partly because you're doing it for reporting for the previous year. There are ways to do what we would call emissions projections. And so this gets into more of the strategy portion of it. But once you've done your inventory and you've planned actions and you know what your company's growth trajectory is expected to be, you can look, say, from now through 2030 and sort of layer all those things in. It's basically sort of a modeling exercise at that point, where you're projecting growth, looking at estimating what the impact of actions are going to be, and try to see kind of what your emissions are looking for. So there are ways to look forward, but generally I would say it's sort of a backward-looking exercise.
Great. Raharshi, if you can mute, that'd be great. There's a bit of a background noise. Wonderful. And I think the last question in the chat is from Bo. I'm sure many people are thinking about the same question. So Bo just got laid off and looked to gain certification in carbon accounting. What are the best places to earn these certificates to show potential employers my proficiency in different scopes? But there are various layers to carbon accounting, which makes me think that earning these certificates will require a source of income.
It's a fair question. I should probably disclose a conflict of interest, but I think the way I'm going to answer the question might help. I would say sort of credibly land a position. It's like several things, like in other places. I think certificates can help. I would say, I think if you can actually get experience, I would say that's sort of superior. Whether that's if you've been laid off, you don't necessarily have the opportunity that you would if you're actually in a business and you can, maybe even volunteer with the team. It might be taking on some extra job responsibilities, but if you have a team that's involved in just getting started, there may be opportunities to get involved where you are working. I mentioned well, I mentioned Climate Label in Change Climate, who has that free tool. They use like a few dozen volunteers every year that gets really hands-on experience, but you need to also have space to be able to to be able to volunteer and like have that time to give. In terms of different certificates, there's Greenhouse Gas Management Institute's one. I have a course through Terra.do that would give a certificate. But again, I think that's sort of like part of like this whole portfolio that you'd ideally get to ultimately land a position. And then the other thing that's maybe the biggest wild card in your favor is just working connections. So once you can show like you've got a certificate, whether if you have like a friend with a specific company that needs help on it, or look at these other avenues that I'm sure aren't new news to you. But I'd sort of take this portfolio approach to really sort of land a position and kind of work in the environment. But certificates can certainly be a portion of it. Change Climate is the organization. Climate Label is kind of their eco label, so it's the same thing. And they used to be named Climate Neutral, so they rebranded in the last year. So if you search online, you might see some confusing things. Okay. I think we did have a couple of other questions. We're just about at time, but let me look back at that. There was the question about ESG reporting. So I'm not ESG, I feel sort of like higher level, but this carbon accounting certainly does play into ESG reporting. And I also mentioned, I also trying to point out how this organizational accounting doesn't really address kind of the project-based accounting for carbon capture. Unfortunately, for the person who sort of asked that, there is a separate process for that and a lot of different project-specific protocols on what you're supposed to do to get carbon credits. With that, I think we'll have to leave it there. Okay, well, thank you all for your time, for your interest. If you are interested in more, Terra.do does have an on-demand course that will be finalized over the next month, where we have like sort of 4 classes, one covering accounting more in depth, then talking about targets and kind of creating a climate action plan are part of it. But thank you again, and we'll hope to see you in climate-related spaces soon.
Thank you.